Good evening. We're going to be looking at some of the causes and responses to the 2008 financial crisis. We'll be going through different causes that led up to the 2008 financial crisis. What were some of the impacts during that time period? What was the aftermath? Different political economic policies that came about from it, and ways that we can prevent a similar crisis happening in the future. So, causes of the 2008 financial crisis. Leading up to basically 2008, there was a financial boom. After the recession, after 2001, the housing market, both stocks and housing market were going up, and large returns every single year. But part of the boom in real estate is that lenders were lending mortgages either subprime. You didn't have to be a very high credit borrower in order to get a mortgage. Alongside with that, you didn't have to state any type of income, non-state income loans or so too. You didn't have to prove that you made X amount of money or so. People could get multiple lines of credit on a property. You can get second mortgages, third mortgages, fourth mortgages, fifth mortgages against property, and use that to buy more real estate, leveraging up your properties. There was increased speculation in the housing market, and basically these banks making these subprime mortgages, which weren't very safe, wanted to go ahead and then make it safer, so they packed these subprime mortgages into mortgage-backed securities. Basically a package of multiple different, subprime mortgages. Not all of them were subprime, some of them were regular mortgages or so too, and sold these off to other banks. And this, spread the risk theoretically. If these subprime mortgages were to go bad, it wouldn't just, take down just one particular lender or two. Also, deregulation of the Glass-Steagall Act. This stopped retail banks merging with investment banks, and this allowed them to join together, so too, putting retail depositors accounts at risk or so too, alongside with investment banks doing riskier speculation or so. Really, the start of the 2008 financial crisis was Lehman Brothers going bankrupt in September 2008. But leading up to that, Bear Stearns, one of the largest investment banks in the world, was already showing some signs of deterioration or so too, which gave warning or so about dangers in the subprime mortgage market. When Lehman Brothers failed or so, it's the largest bankruptcy at that time in U.S. history, and that basically started panic in the markets. Stocks took a dive. People were worried about, okay, if Lehman went under, who's next? Merrill Lynch, Bank of America. We're basically seeing the Great Depression all over again as far as run on banks. Washington Mutual failed during this time or so too, and got bought out by J.P. Morgan Chase. But there was a domino effect beginning to happen in the market. And government had to act quickly. Secretary of Treasury, Hank Paulson, created TARPs, Troubled Assets Relief Program. Part of this was injecting billions of dollars of liquidity into the markets, giving banks liquidity so that there was less fear of failure. So, because investors at that time didn't want to invest at all. Lenders weren't lending, credit was frozen. This was starting to affect Main Street or so too, and there had to be liquidity put into the markets. Same time, Federal Reserve cut interest rates down to zero to help spark stimulation, began quantitative easing, fancy word of just saying buying securities and putting more liquidity in the market in order to cause stimulus and prevent full-on contraction happening, basically stopping recession going into a depression. What were some of the after effects of the financial crisis? Of course, people were upset. Many people lost their homes. Many people lost their retirement. Many people lost their jobs. Creation of Dodd-Frank Wall Street Reform Act this put heavy regulation on financial firms, telling them what they can and cannot do as far as lending, investment activities in the markets. There was increased regulation when it came to having increased reserve amounts for banks. Banks had to carry higher reserves, meaning that they were using less leverage or so as far as with their equity, and there was limits on borrowers as far as when seeking a mortgage. Borrowers could no longer, or lenders could no longer lend subprime mortgages. Instead, you had to go ahead and have a healthy down payment, healthy credit score in order to get a mortgage. Volcker rule limited speculation as far as banks and what they can and cannot, participate, while investing, with depositors' money. Changes in the economy, and what are the possibilities of a similar recession? Well, the good news is that when an economic downturn happens, usually we adjust in order to avoid going that direction down in the future. Doesn't mean we won't have an economic downturn, again. We're having one right now, but it will most likely be not similar to the last one or previous ones or so too. Banks nowadays have higher reserve requirements. We saw this during, March of this year or so too. Banks are healthier. Banks have less debt to equity ratios. They're a lot less leverage. Speculation done by financial firms have less of a chance of, having spillover into the Main Street economy. Lenders or borrowers, for that instance, have to have higher down payments, generally, 20% now, 750 plus credit scores in order to go ahead and get a home. And, Mark Twain had a quote of saying history does not repeat itself, but it does rhyme. So we will see an economic downturn once again in the future. Most likely won't be similar to that of the 2008 financial crisis. What can we do as far as avoiding for future recessions? Well, part of the business cycle, recessions are impossible to avoid, but we can always help soften the landing when that does happen, and also help shorten that part of the business cycle too. We can do this by keeping track of what's going on in the economy, developments, catching warning signs early. We can also have non-bipartisan agreement as far as when there becomes a crisis, injecting liquidity in the parts of the market, areas of the economy that needs it, and that instantly with COVID-19, high unemployment, people not working, sent out billions or almost trillions worth of stimulus for unemployment. So make sure that banks are not over leveraged, since there are leveraged institutions already. Want to make sure they're not, putting depositors' funds at risk and also not freezing up liquidity. These are just some of the ways that we can prevent similar recessions in the future. We have to learn from our past, and it's the only way to keep improving as far as an economy. Not going to be able to avoid downturns always, but at least we can soften them. Thank you so much for listening to my presentation.